Friday, December 4th, 2020, Maneco 64, home of alternative economics and contrarian views. So M1 is going through the roof. We're going to look at M1. It was published yesterday by the Federal Reserve, the latest data. It increased by almost $500 billion in the latest reported week. It was $498 billion to be exact, almost 10% increase from the previous week. Yes, I will hear from a lot of you who believe that the Fed's policy of printing money or creating reserves, or QE, is deflationary. You need to think again, because if it was deflationary, we'd be seeing M1 and M2 actually collapse. And many of you mentioned velocity. Yes, velocity has been going down since 2008, mainly because a lot of the excess reserves that the banks hold from the policy of QE is put with the Federal Reserve, and they earn interest on it. Prior to 2008, they couldn't do that, so there were no excess reserves. So those reserves were lent out to the system. I suspect they've done that to try to keep the banks from collapsing, to keep them from going under, because they're all really bankrupt after 2008. But velocity depends as well on economic activity, because the money supply, of course, is the common denominator. So if the money supply keeps growing, but the economic activity is still slow, of course, that velocity is going to go down. But I would say that velocity is something like akin to a train on a track, a huge or a very long train that's been stuck there for years. And then someone pulls the brake from the track, and there's loads of people partying right in front of that train, and they're gonna get crushed because it's gonna come down the hill and crush them. And I think they won't know what hit them, and that's what I think is gonna happen. People are complacent about all the inflation that the Federal Reserve and the government is creating, and also in other countries, of course. So before we look at the data, because actually money supply velocity M2 is actually just picked up as well, the latest data. So I think that's worrying. Is it any wonder the dollar's been going down so much in the last week or so? Is it any wonder the dollar's dropped from above 100 in March as per the dollar index, and we're now testing 90? No, it's not. But before I look at these numbers, I'm going to reference a book that I've read several times, and I don't think you can find it out there. And if you do, it's quite expensive these days. I bought it over 15 years ago, and the book is entitled The Raven of Zurich. It's the memoirs of Felix Somary. Who is Felix Somary? Well, let's go over his Wikipedia. Not the whole thing, but the most important part, I would say, and the reason why I believe a lot of people are going to be proven wrong, and I trust Felix Somary's wisdom a lot more than other people out there. So it says, in the 1930s, he took the Swiss citizenship. He taught at Heidelberg University as well as in U.S. universities. At Chicago, he was a guest of his friend Schumpeter, with whom he shared the interest in the theory of the economic cycle. Before the start of World War II, he tried to convince Baron Rothschild to take his wealth and his person out of Germany, but Rothschild did not listen to him and barely saved himself. In August 1944, he was one of the recipients on a list that read like who's who in business cycle theory, according to Byomvosky and Trautwein, of a paper concerning theories of the business cycle written by Gottfried Haberler. He was an advisor to the chief of the Swiss Federal Department of Public Economy attending a meeting in Washington, D.C. in 1939 when the Swiss government was trying to obtain emergency war supplies from the U.S. government. He, his wife, 2 sons, and a daughter moved to the United States in 1940, taking the last ship bound for the U.S. from Spain. Bella Bartok was in the same ship, as was the poet and writer Stefan Zweig, with whom Somary was one of the last people to speak before his suicide. From 1941 to 1943, he advised the American Department of Defense on finance issues. He had been consulted regarding the methods that should be deployed in order to establish a sound currency in the European and African war zones. This being seen prior to the Allied landings in North Africa and France as an important prerequisite for achieving economic stability. When they told him that the Americans were thinking of abolishing the Japanese emperor, he was outraged, and this is what he said. And then he asked, "With whom are you going to sign a peace treaty?" So as you can see, Felix Somary was no conspiracy theorist. He was no right-wing fanatic or nut. He was very well respected by governments all around the world. So on page 98, this is what he says about inflation. And I know that most people think that inflation nowadays is CPI, but let's read what he says here. Let's go through this paragraph. On page 98, my book avoided any exaggeration of the role banks play. Theories that at the time were becoming fashionable ascribe decisive importance to banks in the whole economic cycle, which is completely contradicted by the facts. Of the 4 theoreticians who represented this point of view, the most prominent experienced the collapse of his own bank. The second committed suicide after running through the fortune he had inherited. The third had never seen a bank in operation, and the fourth totally recanted his views. That did not prevent the wide dissemination of the deposit myth. Myths generally spread wider and last longer than knowledge of mere facts. And here's the kicker. The state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible. So now let's skip to page 135, where he's talking about default or the destruction of currencies, because that's what we're getting now. It says the First World War was financed in Germany and Austria by war loans that were discounted further by the banks of issue. By the end of the war, the amount of such discounted loans had risen virtually to that of the entire nominal value of the war loans themselves, and the discount interest rates were often lower than the coupon rate on the bonds. In Vienna, a number of insurance enterprises were founded to guarantee the money value of war loans. Throughout the duration of the war, the whole jerry-built structure of illusory values was maintained by a combination of internal restrictions and censorship, especially because after a century of stable money, the population understood nothing about inflation. When the war ended, however, and almost immediately after the defeat, everything collapsed. So it's what they're doing now. People think we've had 20, 30 years or 40 years of no inflation. And yes, there are restrictions on what pension funds can invest. They're forced to buy bonds, just like they were in Austria. So let's continue. At a meeting of the Society of Economics in Vienna, when the mark was quoted at 80 to the dollar and the Austrian krone at 60, I urgently warned of the danger that the currency would lose all its value and proposed immediately after the armistice and repeatedly thereafter that Germany and Austria declare a state of default. So there you go. He was way ahead of his time. He could see the hyperinflation. My reasoning was not understood, and the fact that a banker should make such a proposal was considered paradoxical. However, the state bankruptcy is a one-time surgical intervention, while inflation is a permanent poisoning of the very bloodstream of a society. After state debts are wiped out, new financing can be undertaken immediately, while inflation means a prolonged wait until the currency has lost all value. Despite the enormous loss that state default entails, it clarifies the entire situation, and the total damage thus sustained cannot be compared with the appalling terminal stages of an inflation. So let's keep going. I am today more than ever convinced that my views then were correct. Much wretchedness in the intervening period could have been avoided through an immediate declaration of bankruptcy. The steady series of devaluations, well, that's gold going up versus fiat currencies since 2001. That's what it is. The total destruction of confidence in government. Sounds familiar? The prostitution of the economy, which governments so often slavishly tried to justify. The banks resisted most strongly of all, but they too would have fared better with a default, which would have allowed them to clear their balance sheets immediately. Instead, they dragged on for another decade in Berlin, Vienna, and Budapest, with repeated individual collapses until the worldwide crisis revealed the true dimensions of the situation. As usual, when convinced of the absolute correctness of my views, I proceeded unswervingly toward my goals, regardless of my own interest, and indeed often to their detriment, and quite unmoved by personal antagonisms. And indeed, I would have seen my views adopted had not one element been decisive against me. Default must be declared by those individuals who are currently in office, and at a time when even the most stupid of those affected becomes aware of what is going on. Inflation, on the other hand, can go on for years without its victims becoming conscious of the incredible way in which they have been swindled. So there you go. I'm going to stop at that. And we'll quickly look at these numbers now that came out from the Fed. Some came out yesterday, some have come out earlier. So here's M1. This is M1 money supply. And here's the definition of M1 here on the screen for you. So you can see how it's been really accelerating since the 08 crisis, and since the 2020 crisis, it's picked up even more. It's going parabolic, unlike the virus this year, right? It's going parabolic. This is parabolic, not what we have in terms of health crisis, of course. And then let's look at the 1 year chart, and you can see how it's just suddenly picked up here by almost 500 billion or 8.68%. And let's look at excess reserves, right? Because I think that's one of the big reasons why money supply velocity has gone down. You can see that there were no excess reserves prior to September 2008. And then in October of 2008, Congress allowed banks to keep excess reserves at the Fed and receive interest. And that's when excess reserves started growing. And that's when, if you look here at money supply velocity, that's when it started dropping back in 2008 after the crisis. But if you look at the short-term chart here, we've just bottomed, it looks like. Money supply velocity is jumped up by over 3% from the second quarter to the third quarter. You can see it's jumped from 1.104 to 1.146. So money velocity is picking up. I still think it's like not really important. As Felix Somary said, most people don't know what inflation is. And it only really hits them many years later, and they will realize what inflation is. And it's purely created, can only be created by government through the central bank, as he says. It's difficult to say, of course, when things are going to happen. I'm not sure if Felix Somary knew exactly the hyperinflation, the collapse of the Central European currencies, because it wasn't just the German currency that collapsed, the Austrian currency collapsed, and all the other countries related to the Austro-Hungarian Empire that had broken up, they collapsed as well. I'm sure he didn't know the exact dates, but he knew it was going to happen. And I think we're getting closer and closer to that. M1, of course, is money that you hold in your pocket or bank balances that you have. It's certificates of deposits. It's almost ready money. It's savings deposits, money that you can spend right away. Why did that pick up? Well, there's many reasons why it could have picked up. People might have liquidated some of their investments and put it into cash. Banks might have taken their reserves they have and loaned them out. And they don't even have to take many of those reserves because they can multiply those through fractional reserve lending. So that's probably what's happening. And if the economy starts growing a little bit, I'm not saying we're going to have a boom, but you could see money supply go through the roof, and you could see the dollar and all fiat currency starting to go down the road of collapse. So with that, let's quickly look at where the markets are this morning. So it's 8:49 a.m. So we are at 1840 spot gold. It's down just like 30 cents, so it's basically unchanged. Range has been 1837 to 1845. Silver is up 14 cents, so up almost 2/3%. We're at 24.18. The high's been 24.30, low 23.92. The stock market, the Dow future is up 68 at 30,034, so up 1/4%. S&P is up 1/4% as well, S&P future. NASDAQ 100 future up 1/3. So to the currencies now, sterling is down 1/4% at 134.15. The euro is up 0.1% at 121.58. The dollar is up 1/8% versus the yen at 103.97. Dollar is down 0.2% versus the Chinese yuan at 652. WTI crude is up 2%, almost $1 at 46.64. High grade copper as well, continuing to move up as well. That's up over 1% at 353. So to finish off, we'll look at the 10-year note yield. We're at 0.92, which is unchanged. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Parler, and all these other platforms below here. I wish you all a great day. Take care. Bye.